Good day, everyone. This is our continuation still for adjusting entries, and we are going to tackle with deferrals. To be more specific, another type of deferral because we're done with prepayment of expenses, and this is pre-collection of income that would result to unearned income. So basically, we are able to get or obtain cash first prior to the delivery of the services or the goods in the contract. So here are some sources of unearned income or pre-collected income or deferred income, like an income for interest, but then it is received in advance. The interest is received in advance, and that's the reason that it is still unearned income. Another one is gifts and distributions or the contributions from the respective sponsors, perhaps, or donors or benefactors. So it's possible that gifts are given or contributions or distributions of them are already provided. However, they are not yet earned on the sense that the conditions attached are not yet satisfied. Then rent also, if for example, the rent is not yet applicable for the usage for a particular month, say for example. And dividends, if the dividends are given prior to the actual or supposedly earning point of that, and that's when declaration was made because profits were already earned by the corporations or our investees, for example. Investees meaning the corporations or entities that we have investments with or we have bought shares. Anyhow, so that's going to be, or perhaps that might be a discussion in higher accounting. So we just have to continue. As said, this is now recollection of income wherein cash is received prior to the rendering of services or delivery of the goods. So in that case, that has to be a liability first, in which the account title usually used is an earned income. For some, they're going to use deferred income or pre-collected income, which actually means the same. Example of that would be the magazine subscriptions, wherein the payments from the clients or customers or subscribers specifically are received in advance by the publishing companies. So the publishing companies have to record them as liabilities first. And when the magazines have been distributed to them, in that case, that's the time that the respective fair values of the magazines will be recorded as income. Okay, so from the unearned subscription revenue, it will be transferred to the revenue account, which is subscription revenues. So initially, the value of the goods or services to be provided in future periods will have to be recognized as liabilities and earned revenues in the balance sheet. And as they are, of course, recognized as revenues when the goods or services are provided or delivered or rendered to the intended buyers or customers or consumers. So from liabilities and earned revenues, they would become revenues depending on the contract. So in this case, what if we have a referral revenue? And this is one way by which the company, weddings, or us would earn in the process. So take note that they've earned like 4,000 only out of the 10,000 from the referrals because this 4,000 at the end of the month, they have already taken their marriage vows. All right. So it's really like an income recognition point in this particular situation for referral. So in this case, the referral will be really earned when those who are actually referred as clients to wed has actually wed. Okay. So anyway, in that case, let's journalize the transaction. Initially, that was like debit cash in bank, credit, and earned referral revenues as our initial entry for the receipt of cash. Now, when this was adjusted or this has to be adjusted, our entry would be we are going to recognize the revenue for referrals or referral revenues at 4,000. Then we are going to debit the liability, which is still the balance. Remember, guys, liabilities have normal balances of credits. Prepaid expenses have normal balances of debits. That's why when the latter was adjusted, we place that on the credit side. But this is pre-collection of income wherein the liabilities of balances on the credit side. Therefore, when we adjust, we put it on the debit side and earned referral revenues, which are liabilities, and the revenues for the referral, which would be income, 4,000 each. Okay, so that's it for the example for pre-collection of income. So we just have to think the opposites. Now, we'll also know the similarity with the prepayment of expenses, wherein there are also other methods, or let's just say the alternative methods, which I will discuss later on. However, before we proceed to that, let us take note once and for all that, again, what is to be regarded as the method when the problem is silent and the method wherein that is really being used initially, even if there is no provision in the problem, has to be the balance sheet method, in which for pre-collection of income is liability method. And the other method would be the income statement method, which is income method. All right, so this is the sample now for unearned revenues. In the example, Marasigan Company, it received on July 1, 2019, a check that is worth 48,000, good for 2 years rent that is paid in advance. So clearly, this is an unearned rent revenue or an earned rent income of 48,000, which is a liability, and that's credit. So the debit, of course, is the receipt of cash. We can just notice that we somehow disregarded the cash. It's because we already know it that for prepayments, we will credit that, and for the pre-collection of income, we will debit that. Okay, that's liability method. And that's why let's skip that. When we make the adjusting entry later on for the 6 months, take note this was July. So from July to December 31, that's 6 months. And we have 48,000 good for 2 years. So 2 years is composed of 48 months, right? Sorry, 24 months. Sorry, so that's 24 months for 2 years. 48 months in 4 years. Okay, good. So that's 48,000 divided by 2 years divided by 24 months equals 2,000 per month, right? Times 6 months that already expired. So that's 12,000. So unearned rent revenues would be deducted by the amount of the revenue of 12,000. So rent revenue is recognized credit, while the unearned will be deducted by the 12,000, so that the balance 48,000 minus 12,000, 36,000 is the amount of liability, which is what's going to show here. Revenue is 12,000, unearned rent revenue is 36,000. Then what about for the option, another option or alternative method, or another method, which is the revenue method or income method? So initially, everything is recorded as income or revenue, 48,000. Our adjusting entry will focus now how much is the unearned rent revenue, or how much really is the liability. So in this case, that would be 12,000, remember, as income. So what amount should we deduct from 48,000 to get the balance of the income, which is really at 12,000. So income initially 48,000 here minus the 36,000 amount equals 12,000 income. Therefore, the 36,000 will have to be the adjustment. And coincidentally, that's also the value of that unearned rent revenue, meaning if you don't analyze that much, it would be easy. How? Income method, focus is the liability. How much was the liability? 36,000. So credit 36,000. That's it. And if you deduct 48 minus 36, of course, that's going to be the 12,000 revenue. Talking here or about the rent revenue. So it's here, 48,000 minus the 36,000, that's 12,000 revenue. And the 36,000 is the liability, which is also true here. For the income, and earned rent revenues would be 36,000 credit, that's the liability, and the rent revenue is income, which is 12,000 credit. All right. So bottom line, the prepayments and pre-collection of income, prepayment of expenses to be more specific, and pre-collection of income are actually deferrals, because the recognition of expenses and income respectively are deferred because initially they're recognized as asset and liabilities or liability respectively. However, if we just have to follow like what method has been used and adjust appropriately, then we'll be able to get the desired balances. Also, we should not forget that the balance sheet methods for prepayment, that's the asset method, and for the pre-collection of income liability method will be treated as the default method or the given method, most especially if the problem is silent or it's not stated as to what method was used. Although also we can know what method is used by looking and reading into the problem as to what was the balance of the account from the unadjusted trial balance. Because if we have seen there that the account was entirely an expense, meaning to say that's usage of expense method for prepayment. If we see that, oh, the entire amount is liability, meaning that's balance sheet method, liability method for pre-collection of income. So hopefully that helps in order for you or us to clarify things out. Thank you very much for listening to this one. Thank you and God bless us all.